What if I told you there's a way to own a piece of America's 500 biggest companies with just one investment? Imagine having a slice of Apple, Google, Amazon, and hundreds more, all in your pocket. Sounds too good to be true, right? Well, buckle up, because today we're diving into the world of the S&P 500, the heavyweight champion of the stock market. Picture this. It's 1957. Elvis is on the radio, the space race is heating up, and a group of financial wizards are about to change investing forever. They create an index that would become the pulse of the American economy, the S&P 500. This index has turned thousands of people into millionaires, survived market crashes, and even predicted presidential elections. Yeah, you heard that right. But here's the kicker. Despite its power, most people don't really understand what the S&P 500 is or how it works. Whether you're a complete newbie or you've been dabbling in stocks, this video is your golden ticket to understanding the beating heart of the US stock market. Let's start with the basics. The S&P 500, short for Standard & Poor's 500, is like the all-star team of the US stock market. It's an index that tracks the performance of 500 of the largest companies listed on US stock exchanges. But here's the thing. It's not just a list of the 500 biggest companies. These companies are carefully selected to represent the US economy as a whole. Now you might be wondering, who's behind this selection? The index is maintained by S&P Dow Jones Indices, a joint venture between S&P Global, CME Group, and News Corp. They have a committee that meets regularly to determine which companies should be included in the index. The index includes companies from various sectors of the economy. We're talking tech giants like Apple and Microsoft, but also consumer goods companies like Procter & Gamble, healthcare firms like Johnson & Johnson, and energy companies like ExxonMobil. Now, why should you care about the S&P 500? Well, it's widely considered the best gauge of how the US stock market is doing overall. When you hear on the news that the market is up, they're often referring to the S&P 500. It's used as a benchmark for the performance of many mutual funds and exchange-traded funds, ETFs. Let's talk numbers. As of June 28, 2024, the S&P 500 index value stands at 544.22. This number represents the combined value of all 500 companies in the index. But what does this number mean and how is it calculated? The S&P 500 is a market capitalization weighted index. This means that each company's weight in the index is proportional to its market value. Let's break that down. Market capitalization is calculated by multiplying a company's stock price by the number of outstanding shares. For example, if a company has 1 million shares outstanding and its stock price is $100, its market cap would be $100 million. In the S&P 500, companies with larger market caps have a bigger impact on the index's performance. For instance, changes in Apple's stock price will affect the index more than changes in a smaller company's stock. To calculate the index value, S&P uses a complex formula that takes into account the market caps of all 500 companies and divides by a factor called the index divisor. This divisor is adjusted to account for stock splits, spin-offs, and other corporate actions, ensuring the index continuity. Now let's take a journey through time. The S&P 500 was introduced in 1957, but its history is calculated back to 1926. Over the years, it has become the go-to indicator for the overall health of the US stock market and, by extension, the US economy. Now you might be wondering, can I invest in the S&P 500? The answer is yes. While you can't directly buy the index itself, you can invest in index funds or ETFs that track the S&P 500. These funds aim to mirror the performance of the index, giving you exposure to all 500 companies with a single investment. One popular option is the SPDR S&P 500 ETF Trust, often referred to by its ticker symbol, SPY. It was the first ETF listed in the United States and remains one of the most heavily traded. Other options include the Vanguard S&P 500 ETF. BOO and the iShares Core S&P 500 ETF, IVV. Investing in an S&P 500 index fund is a great way for beginners to get started in the stock market. Here's why. Diversification. You're instantly invested in 500 of America's top companies across various sectors. This helps spread your risk. Low costs. Index funds typically have lower fees than actively managed funds because they don't require a team of analysts trying to beat the market. Historically solid returns. Over the long term, the S&P 500 has provided average annual returns of about 10%. Of course, past performance doesn't guarantee future results. Simplicity. It's a straightforward way to invest in the overall US stock market without having to pick individual stocks. But remember, like all investments, the S&P 500 can go up and down. While it's generally grown over time, there have been periods of significant decline, like during the 2008 financial crisis when it lost about 38% of its value. Let's talk about some strategies for investing in the S&P 500. Dollar cost averaging. This involves investing a fixed amount regularly, regardless of the index price. This can help smooth out the impact of market volatility over time. Buy and hold. Many investors choose to buy S&P 500 index funds and hold them for the long term, riding out short-term market fluctuations. Rebalancing. Some investors periodically adjust their portfolio to maintain their desired asset allocation between stocks, bonds, and other investments. It's also worth noting that while the S&P 500 is a great core holding for many investors, it's not the only index out there. Other popular US indexes include the Dow Jones Industrial Average, which tracks 30 large publicly owned companies, and the Nasdaq Composite, which includes more than 3,000 stocks listed on the Nasdaq exchange and is heavily weighted towards technology companies. For international exposure, you might consider indexes like the MSCI World Index or the FTSE All World Index, which include companies from around the globe. So, how can you start investing in the S&P 500? First, you'll need to open a brokerage account. There are many online brokers to choose from, like Charles Schwab, Fidelity, or Robinhood. Once your account is set up, you can buy shares of an S&P 500 index fund, or ETF. As Warren Buffett, one of the world's most successful investors, once said, a low-cost index fund is the most sensible equity investment for the great majority of investors. He's even instructed the trustee of his estate to invest 90% of his money for his wife in a low-cost S&P 500 index fund. Remember, investing is a long-term game. The power of the S&P 500 really shows over time as companies grow and dividends are reinvested. Speaking of dividends, many companies in the S&P 500 pay dividends to shareholders. When you invest in an S&P 500 index fund, you'll typically receive these dividends, which you can either reinvest or take as cash. Before we wrap up, let's address some common questions about the S&P 500. How often does the composition of the S&P 500 change? Companies can be added or removed from the index at any time, but major changes typically happen quarterly. What happens if a company in the S&P 500 goes bankrupt? It would be removed from the index and replaced with another company. Can the S&P 500 include non-US companies? While the companies must be listed on US exchanges, some, like Medtronic, are headquartered outside the US. How does the S&P 500 compare to other stock market indexes? It's generally considered more representative of the US stock market than the Dow Jones Industrial Average, which only includes 30 companies. So there you have it, a comprehensive beginner's guide to understanding the S&P 500. It's a powerful tool for tracking the overall US stock market and a great starting point for new investors. Remember, while the S&P 500 has historically provided good returns over the long term, all investing involves risk, and it's important to do your own research and consider your personal financial situation before making investment decisions. Have questions? Drop them in the comments below. And don't forget to like and subscribe for more investing insights. Until next time, happy investing.